assets. So asset decrease, credit. So 17 is our expense. Expense increase, debit. Entry would be expense to asset because asset decrease. So what is the name of the expense? Supplies expense, right? And what is the name of the asset that decrease? Supplies. Understand? Supplies expense to supplies. So focus should be on expense, not supplies. So many students, they focus here supplies to supplies, what's going on? No, it is supplies expense because that is the $1,700 is that what we have used during the year. So we convert that into expense. Expense, supply expense to supplies. Don't focus on supplies. Expense to supplies because we can transfer that 1,700 to expense account and less from our assets, which is 3,200. We did, decreases 1,700 because we used worth of 1,700. Yes, Florian.
So this transaction happened in the same column, which is asset.
No.
Because, okay, so
this is our expense. This will go to income statement. This is our balance sheet item. So there will be a reduction. So if you transfer this into, do we have it here? No. So if you transfer it into T account, so there will be two T accounts. One is expense T account and the other one is supplies. So we have supplies here. And this side we have 3,200. The balance is 1,700 decreased because this is credited, right? So the balance would be 1,500. And this one goes to supply expense. Expense is the debit side here. So you write it down 1,700. So this will go to income statement and this 1,500 will go to balance sheet under supplies. Florian, you understand?
I just would like to know the first T account, supply expense. This one go to the assets, right?
No. Expense. Come on, it's expense.
Go to liability then.
Press on expense. Expense is?
You say the other time, expense is supply and supply is go to assets. I spend on my supplier money, I give him cash.
This is
I
not,
increase my liability.
not supplier. Come on, man. Supplies is our day-to-day necessities like stationery, papers, ink.
Ah, okay.
Supplies, not supplier.
Okay.
Right? So day-to-day office things.
Okay.
Supplies, like some sticky notes, this kind of stuff.
Yeah. Okay.
Okay. So we have first at the start of the year, we have purchased, we had 3,200 worth of stationery or whatsoever, right? And at the end of the year, we have 1,500. So how much supplies we have used? Office documentation, papers, and all the stuff. We printed that paper. Paper is wasted.
1,070. We spent.
Now you understand? So that expense, we expense that one. So it will decrease. Supplies also decrease. Now, our third illustration of adjusting the entry is salary expense. Now, I'm going to be opening a breakout room, and the next two illustration you are required to do in a group. Okay, so you are welcomed over there to revise your concept in break-even group. So you can turn on your video and you can just face-to-face you talk about that and have a group discussion. And this is a group activity. Okay, so I'm going to be setting up breakout room activity. I am making 3 groups. So first of all, please take a picture, and the next, the fourth adjustment I will be sending you in WeChat group. Okay, take a picture. Here we go. Please accept the breakout room. Please turn on your video here in breakout room as well. And for those who are watching our online video, please, I'm stopping, pausing my video here, and I will be resuming once we go back, once we finish our breakout room activity. So please, wait for that. Okay, guys, welcome back after breakout room activity. So let's do that. Let's compare your answers. Please mention your, group member's name, and please send all the activity on group. This is group activity. Okay, I'm expecting 3 files from each group. Okay, let's do that. So we have.
Wait, sir, why 3? Why 3 files? I thought it was only 2 questions we had to answer.
No. 3 group files means 1 file for each group.
Oh, sorry.
Okay. So, yeah. So let's do that. So we need to adjust the entry. So we have 2 questions in our breakout room. One would be on the next of this, the coming slide. So let's just do this one. So salary expense is 7,000 per day, Monday through Friday. And the business pays employees each Friday. It means every employees are entitled to receive their salary on Friday. But this time, the closing year is 31st of December. It is on Wednesday. So recall your the principle of matching principle, expense and revenue recognition principle. That is, 2014 expense and revenue will be recorded on 2014. So on 31st of December 2014, how much salary expense belongs to 2014? 7,000 multiplied by 3, which is 21,000. Right? So I'm just gonna, here we go. Right? So it means expense occurred, but did we pay? We will pay on Friday. It means on Wednesday we didn't pay. So it means we will pay later. We create liability. So expense occurred, yes. When expense occurred, debit. Expense increase, debit. So we create liability, liability increase, credit. What are the name of the accounts? Number 1, expense. Which expense? Salary expense. And liability gonna be salary payable. So salary expense to salary payable, 21,000. Right, everyone? Now next, move to our next one, which is, let me read that. So we also need to adjust the entry on 31st of December 2014. So on July 1st, 2014, when the business collected 15,000 rent in advance. So it means we are talking about prepaid expenses. So in specific way, we are talking about prepaid rent. So it debited cash and credited unearned rent because we are in renting business. Oh, okay. Unearned rent revenue. So we are in renting business. So it means our sales or our revenue would be rent. So tenant was paying for 1 year rent, right? So since we received in advance on July 2014, right? So how much we collected for the whole year? For the whole 1 year rent. So
12 months.
So you collected on July 1st, right? And your year is ending on 31st of December. So he paid, come on. He paid for the whole year, July to June 30. And your December ends here. It means 6 months rent is now expired, or his 6 months rent is expired on December 31st. So first of all, when you receive that amount, the question also says that what we have done, we create liability, unearned revenue, unearned rent revenue, credited. So on July 1st, entry that they did, cash received 15,000 to unearned rent revenue 15,000, right? Because we didn't deliver the goods, we didn't perform the services of rent, right? We received in advance. But now our financial year or our accounting year is closing at 31st of December. So how much rent we are entitled to transfer that one into our revenue, because our business is in renting, right? Renting services. So out of 15,000, half of the year rent is now we performed. It means we are entitled to charge half of that into our revenue. So can we do all 15,000? No, because our that is paid on July 1st and our year closes on 31st of December. So at the end of the 1 year, what would be the entry? So out of this unearned rent revenue, which was our liability, how much we have paid off our liability? Half of them. Half of them we have delivered the goods, like that. If you convert that one into a manufacturing or delivering goods business, so half of the sales we already done. So it means half of the liability we already paid off. So there is going to be decrease in liability. Decrease in liability means debit, right? So when decrease in liability debited, so what would we create? Revenue, only revenue, rent revenue, revenue increase, credit. Now it's the time on 31st of December, we can claim that we have revenue. Before that, it was our liability, right? So what would be the entry? Unearned rent revenue to revenue, rent revenue, 7,500. Right, everyone? Let me ask personally. Florian,
Sir,
understand? Yes,
yeah,
please.
I understand. But why you don't, because the business is the rent, why you don't use it as asset? For like, you know, like before, it's like we pay something, we pay our supplier